Good morning. My name is Frank Grinnell. I've been advising professional money managers and investing in the stock market for over 20 years. It serves as my day job, but most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we actively manage dynamic stock and ETF models for financial professionals and their clients, as well as individual investors. If you want to learn more about what we do, send me a note, frank@grinnellcapital.com. You can also find more of my insights on Twitter @GrinnellFrank. And now, today's Street Views.
Hey, good morning. Happy Monday, 29th of August, 2022. Hope you had a good weekend. That was quite the fireworks display on Friday in our markets. Equity futures lower, continuing Friday's fairly large decline. We were bouncing off the lows a bit, looking down a little less than 1% last I checked, with the exception of the Russell, which is looking down a little bit more than that. Commodity land, sad gold down again after a beat down on Friday. We are looking for re-entry there on the long side, even though I call it sad gold. I still do want to get back in there. I do think it's going to make sense. I'm watching the dollar, taking my cues from there. The dollar could be topping. I've heard some smart folks talk about the idea that maybe the dollar is topping around here. No one knows for sure, but that would be, in my mind, part of a cue for a re-entry in the gold trade. There is one, hold on a second, I got a sound issue. There we go. Also taking a look at copper down 2%. Interesting to watch because you've got the supply-demand capacity issues all pointing to a long trade there, but you've also got the slowing macro situation, which points to uninvolvement to potentially a short trade there. We are still long. We recently repurchased Freeport-McMoRan, still long there. We're going to see how that acts. Nat gas is down, oil is up a bit, and corn and wheat still really trying to reassert themselves. They've been acting pretty well. The ag trade seems to be back on. We're long Mosaic. We may extend that out, not sure. ADM has been acting well. CF's been acting really well. All those names look like potential purchases on the pullback. So we all know how tough Powell's talk was on Friday. He's talking about going to get the job done. He's talking about there's going to be pain. There is no pivot. If you thought there was going to be one, don't be looking for one. I think that should be imminently clear. Not anytime soon anyway. We're kind of in uncharted territory here with regard to anything in recent memory, anything in the past few decades with regard to monetary policy. You've got tightening into a significant macro slowdown. We've already gone through part of the interest rate driven bear market, a la the Fed, what have you. There's more of that to go. And now you have to ask yourself, how bad is the earnings driven bear market going to be? Because we really haven't seen earnings estimates come down as much as one might hope. They think they were 250 something for 23. Now they're 240 something for 23 for the S&P 500. And obviously that number is too high. I don't know how low it goes. Does it go to 200? Does it go to 175? Hard to say. There are some folks who are in the sub 150 camp with regard to earnings per share for the S&P 500 for 2023. That is pretty light. If you go and put a 16 multiple on something like 150 for 23, that gives you 2,400 on the S&P 500, which would be quite a bit further south from where we are right now. But I do think for sure the next few months are going to be very tricky. I think that CPI is still going to print pretty warmish. I mean, hopefully it's going to still come down. That feels like the right move. It feels like things are slowing very quickly out there, whether it's regard to home sales activity. News this morning about bookings on flights going down pretty quick. I think people are very quickly starting to seize a lot of discretionary activity, which is good. That's what you want. And the next big shoe to drop is on the job side. So we've got to see jobless claims rise. We've got to see wages plateau, potentially pull back. That's what they want to see at the end of the day. That's the things that really can help tame inflation. So the other thing to ask yourself is Powell bluffing? And is he potentially going to blink when the market gets incrementally crushed and all macro data points point towards a severe recession? That's some folks are in that camp. I think he is kind of BSing a bit to the extent of his temperament, and he will balk when things get really rough out there. Who knows? You got to take him at face value, I think, right now. So with that being said, I think it makes sense to have an unusually large amount of cash on hand. We've got about 20 right now. I see us going north of 30 before Wednesday, to be honest, and potentially even higher than that. We are looking to re-engage in long-dated treasuries. I think the long end of the yield curve looks like that's potentially attractive. Maybe that has bottomed. TLT is the example that any and all can participate in. Also on gold, looking for a re-entry point back in there as we discussed. And other than that, the same trades that we've been doing, I mean, whether it's large pharma, things of that nature, I think I'm really close to punting med device X like crap. No reason to be involved if it's just going to break down again. So that's one thing I am looking to punt. And other than that, I'm not all that overly concerned in what we hold. Market to stocks, not just the stock market. Have an awesome day. Good luck out there.
And now for some important disclosures. Grinnell Capital is a state-registered investment advisor. Services offered by Grinnell Capital can only be offered in certain states where Grinnell Capital is registered or meets required exemptions. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisorinfo.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be construed at the provision of personalized advice and is subject to change without notice. This material should not be considered as a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility therefore. This podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve strong relative and risk-adjusted returns, primarily by investing and trading in securities issued by companies that focus on the global information, technology, consumer, healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth, an abundance of both new and maturing product cycles, a high degree of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization, and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange-traded fund, ETF, strategy with investment objectives similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some downside protection in the event of significant market stress through investments in ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, Grinnellcapital.com.